First of all, thanks, Sarah, for having me on. So one of the things we've been telling clients is that we do want to be selectively buying here. We've obviously seen a pretty broad-based sell-off in markets, although the last 2 days have been more encouraging. But we are talking about the fact that with indiscriminate selling, what you do see is opportunities unlocked in the types of names and companies that we think offer value, where the long-term cash flows aren't impacted, and there's strong fundamental value. So we're taking a very discriminating approach towards how we're telling people to engage in the market.
Mike Ryan, I mean, what have your clients been asking you, and has that changed in the space of a couple of days when we've seen markets bounce? Has it changed your clients' psychology at all, or is this still a moment of fear and panic for them?
Well, first of all, Wilfred, I think there's been just an incredible whipsaw for individuals, because remember, we're not just dealing with this as investors. People are also dealing with this from the human aspect, and that they're either fearful of their own safety and their own health, as well as family members of the community. So I think they're grappling with two things at once. One is the health impact and making sure that they're safe and secure, and the other is the economic fallout and trying to gauge what the investment impact is. And I think sometimes it's a little difficult to separate those. As you become more anxious about your own personal health, you tend to focus a little bit more on what the downside is in terms of the economy and financial markets. I do think what is really encouraging, and certainly has supported the markets in the last couple of days, has been the increased responsiveness of policymakers. We've argued here that this would take a multifaceted approach towards stabilizing markets, and that we would have to see a significant mobilization not only of monetary policy, but also importantly of fiscal policy. So we got the monetary policy response. The Fed responded pretty quickly. Now it looks like we've moved further ahead in terms of the fiscal policy response.
Mike Santoli, to that point, I mean, a few days ago, we were here watching credit spreads. We were here watching that very strong dollar and talking about some real stresses and scary signs that were happening in the markets. That looks to, for now, have been alleviated by the Fed action. What do you read into the moves there, and what do they signify for stocks?
Yeah, for sure. They've definitely been medicated. I do think that the idea that the Fed is there as the buyer of last resort across multiple parts of the bond market gives you clearance, if you are an actual private investor, to say, okay, maybe I'll go in and see if any of these junk bonds now trading at 10 or 11% yields, which most of them are, look like they're actually money good, right? So that process, I think, is underway. It's still tentative. It's not necessarily as if we have these great liquid markets anymore. You are seeing investment grade corporate issuance. So that's good. It just means markets are not malfunctioning. It's not as much forced selling and all the rest of it. Now, what we don't know is what exactly is the market right now pricing in terms of duration of shutdown, what it means for wear and tear on corporate balance sheets and various commercial businesses. And that's, I guess, for another time. So I think we're out of that zone of disorderly forced selling for the moment. And beyond that, I think you have to just decide, are you in the business of increasing equity exposure when stocks have underperformed bonds by 25 percentage points in 3 months, or are you not trying to rebalance into that? And that's, I think, the longer term investor's perspective is to make that call.
Mike Santoli and Mike Ryan, thank you both very much.